Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Medpace Holdings Inc. Annual Report. Medpace Holdings Inc. provides a comprehensive range of services to the pharmaceutical, biotechnology, and medical device industries. The company's suite of services includes clinical development support from Phase I to Phase IV across various therapeutic areas. The services offered by Medpace include clinical development services, development plan design, coordinated central laboratory services, project management, regulatory affairs, clinical monitoring, data management and analysis, pharmacovigilance, new drug applications, submissions, post-marketing, clinical support. In addition to these core services, Medpace also offers specialized services such as bioanalytical laboratory services, clinical human pharmacology, imaging services, electrocardiography, reading support for clinical trials. These services enable the company to provide a one-stop-shop solution for its clients, supporting them throughout the entire clinical development process. Unfortunately, I do not have access to the text you provided. However, I can still provide a general overview essay on what may cause a stock price to increase. The stock price of Medpace Holdings, Inc. has increased in the past year due to several factors that contribute to its growth and success as a company. One key factor is the increasing demand for clinical research services, which Medpace provides to pharmaceutical companies. As more patients are diagnosed with chronic diseases, there is a greater need for innovative treatments, driving up demand for Medpace's services. Another reason for the stock price increase is the company's expansion into new markets and geographies. By establishing operations in emerging regions such as Asia and Latin America, Medpace has been able to tap into growing markets and increase its revenue streams. This strategic move has helped the company to diversify its client base and reduce its dependence on any one particular market. Additionally, Medpace's commitment to innovation and technology has also contributed to its growth. The company has invested heavily in digital solutions that enable faster and more efficient clinical trials, which appeals to pharmaceutical companies looking for ways to streamline their research processes. This focus on innovation has helped Medpace to stay ahead of the competition and attract new clients. Finally, the company's strong financial performance has also contributed to its stock price increase. Medpace has consistently reported robust revenue growth and profitability, demonstrating its ability to execute on its business strategy and deliver value to shareholders. As a result, investors have become increasingly confident in the company's prospects, driving up demand for its shares and causing the stock price to rise. Overall, the combination of increasing demand for clinical research services, strategic expansion into new markets, commitment to innovation, and strong financial performance has all contributed to Medpace Holdings, Inc.'s stock price increase in the past year. Medpace Holdings, Inc. market capitalization of $13 billion is significantly larger than the average industry peer of roughly $1 billion. This shows that Medpace Holdings, Inc. holds a significant advantage in their industry. Medpace Holdings, Inc. trades at a higher price-to-earnings ratio of 29 times and a higher price-to-book ratio of 27.5 times relative within the industry. This makes the stock appear much more overvalued compared to its peers. However, the broader industry is also trading at elevated valuation levels, suggesting sector-wide optimism rather than company-specific overvalue. Investor should evaluate if the stock is worth its premium price. The leverage on the balance sheet appears elevated, with liabilities of 61% of total assets. This raises some concern, and we should examine the industry and nature of the business to determine whether they justify the elevated leverage. Liabilities have grown faster than assets and equity, which is somewhat concerning. However, asset growth remains positive, suggesting management may be temporarily leveraging liabilities to fund expansion. Shareholder equity has declined over the past 5 years, but operating income remains positive. The equity weakness may stem from capital structure changes such as buybacks or dividends rather than operational deterioration. The company has aggressively reduced its share count by more than 5%, while revenue, profits, and assets have grown. This represents a very favorable capital allocation strategy, with management materially increasing per share value. The income statement shows that the company have been growing its revenue annually, and the operating income have been increasing. This shows that the business model works and the business is expanding. The company comfortably covers its interest expenses through operating income and maintains a strong cash position relative to current liabilities. Additionally, special charges appear non-recurring, suggesting high earnings quality and strong financial resilience. The primary drivers of revenue growth or decline for a company can be identified through various factors. On the growth side, expansion in the phase IV CRO market has been a significant contributor to revenue increase. Additionally, net new business awards and backlog have also played a crucial role in driving revenue growth. Strong activity within specific therapeutic areas such as metabolic, oncology, and central nervous system has also contributed to revenue growth. Furthermore, an increase in reimbursed out-of-pocket expenses by $266.8 million has positively impacted revenue. Higher personnel costs to support growth in service activities have also been a factor. The company's ability to recognize unbilled services as revenue and advance payments from customers for study contracts have also contributed to revenue growth. On the decline side, potential loss, delay, or non-renewal of contracts has been a significant driver of revenue decline. Non-payment by customers for services performed has also had a negative impact on revenue. Conversion rates of backlog to net revenue have historically been lower than expected, leading to revenue decline. Contract terminations and cancellations by customers have also contributed to revenue decline. Other factors such as delays and modifications to contracts, product withdrawal following market launch, shutdown of customers' manufacturing facilities, changes in scope of work during the course of a project, and cancellation or delay of projects have all had a negative impact on revenue. Net income experienced a mixed trend between 2024 and 2025. Initially, it increased by 11.6% from $404.4 million to $451.1 million due to various factors. However, this growth was short-lived as net income decreased significantly in the following periods. The decrease was attributed to cost overruns, reduced contract profitability resulting from pricing changes, and a substantial increase in valuation allowance, which led to an 81% decline in net income. Profit margins also underwent significant fluctuations during this period. Initially, operating margins decreased due to increased pricing pressure and inability to achieve efficiencies in operating expenses. However, profit margins eventually increased from 6% in 2023 to 8.9% in 2025. This increase was likely influenced by the company's ability to adapt to market conditions and optimize its operations. The reasons behind these changes were multifaceted. Various factors such as foreign currency translation, stock-based compensation expense, and stock options exercised contributed to the fluctuations. Additionally, uncertainties in estimating costs and revenue recognition, volume rebate arrangements with customers, and incentive fee arrangements with customers further complicated the situation. The company's financial performance indicates a positive trend in its ability to generate operating cash flow. According to the data, the net cash provided by operating activities has increased from $608,815 in 2024 to $713,223 in 2025. This significant increase suggests that the company is efficiently managing its operations and generating sufficient cash to cover its expenses, resulting in a positive operating cash flow. The company's financial situation has undergone some notable changes. A closer look at the data reveals that the total liabilities have increased, rising from $1,275,321 in 2024 to $1,516,401 in 2025. This indicates a significant increase in debt level over the past year. However, despite this rise in debt, interest expenses have actually decreased substantially. In fact, they have dropped to zero in 2025, down from $171 in 2024. This suggests that the company has managed to reduce its interest burden, which could be attributed to various factors such as refinancing or restructuring of debts. Overall, while the company's debt level has increased, it is the decrease in interest expenses that stands out as a significant change. This development may have positive implications for the company's financial health and bottom line. The performance of various segments and regions in the recent period has been mixed. Europe stood out as a strong performer, with Belgium experiencing a notable increase of $4,441,000. In contrast, Asia-Pacific saw minimal growth of just $358,000. Meanwhile, the United States showed a slight improvement of $3,206,000. On a category basis, oncology and metabolic segments performed well, with increases of $96,000, $348 and $287,415 respectively. However, the other category experienced a decline of $22,836. Management is optimistic about the company's outlook, citing opportunities for growth in the phase IV CRO market. The company plans to expand its market share by conducting clinical trials across various therapeutic areas, with a strong focus on oncology, metabolic disease, cardiology, CNS, and AVAI. This expansion will be driven by its disciplined operating model, which provides full-service clinical development services. In addition to organic growth, management is also exploring selective bolt-on acquisitions and investments to further expand operations. These activities will be funded through existing cash flow from operations, and potentially borrowings under the company's credit facilities or other debt. The company's commitment to safety, employee loyalty, and sustainability remains a top priority, with a focus on preventing work-related injuries and illnesses. Management is also emphasizing the importance of talent development, with a robust career path and compensation structure in place to acknowledge associate performance and development at all levels. By attracting, developing, and retaining top talent, the company aims to sustain organic growth and drive long-term success. Overall, management's strategy is centered around expansion, innovation, and people development, while maintaining a strong commitment to safety and sustainability. The company's financial activities over the past year have been notable in two key areas. Firstly, it is clear that the company has not paid any dividends to its shareholders. This decision suggests a focus on reinvesting profits within the business rather than distributing them to investors. In contrast, the company has actively engaged in share repurchases. In 2025, it spent $912.9 million buying back shares from the market. This move is likely aimed at reducing the number of outstanding shares and thereby increasing earnings per share for remaining shareholders. Supply chain disruption concerns loom large. The current state of supply chains is marred by several potential disruptions that could have far-reaching consequences. One major concern is the risk of regulatory authorities delaying projects, which could lead to a halt in production and delivery of goods. Additionally, customers becoming unwilling or unable to fund clinical trials poses another significant threat. Furthermore, the reliance on third-party support services has been identified as a cause for supply chain disruption. This vulnerability can be exacerbated by external factors such as tariffs, currency exchange controls, and longer payment cycles in foreign jurisdictions. These risks are not limited to one specific area, but rather are widespread, making it essential for companies to develop contingency plans. The financial implications of these disruptions are also evident, with a notable increase in backlog by $125 million as of December 31, 2025. This significant jump highlights the potential consequences of supply chain disruptions and underscores the need for proactive measures to mitigate these risks. That concludes the financial summary for Medpace Holdings Inc. Feel free to comment below, and I will be happy to answer them when possible.